Most people have no idea that one of the biggest stories in precious metals isn't happening in gold. While headlines focus on central banks accumulating gold, geopolitical tensions, and record government debt, something quieter has been unfolding beneath the surface. A market that powers solar panels, electric vehicles, artificial intelligence infrastructure, medical devices, and modern electronics has been running persistent supply deficits for years, and yet many investors barely notice. Here's what's really happening behind the headlines. Everyone is watching gold, but smart money is increasingly paying attention to silver. Not because silver is simply cheap gold, not because of sensational predictions, but because few people understand the chain reaction that could unfold when a strategic industrial metal collides with rising global demand, constrained supply, and an increasingly unstable monetary system. Think about the world we're entering. Artificial intelligence requires enormous amounts of electricity and data infrastructure. The energy transition demands vast quantities of metals. Governments are running record deficits. Debt continues to expand. Supply chains remain fragile, and geopolitical rivalries are forcing nations to rethink resource security. Most investors are looking in the wrong place. Because silver occupies a unique position unlike almost any other asset on Earth. It is both a precious metal and an industrial metal. It is simultaneously money and a critical component of modern civilization. And history suggests that when these two forces begin pulling in the same direction, markets can change much faster than most people expect. Over the next few minutes, we're going to explore 6 critical insights: why silver's story is bigger than many realize, the hidden supply challenges facing the mining industry, why industrial demand is changing the equation, what history teaches us during periods of uncertainty, why institutions and sophisticated investors are paying close attention, and what all of this could mean for ordinary people trying to preserve purchasing power in an increasingly uncertain world. Because sometimes the biggest stories aren't the ones making headlines. Sometimes they're quietly developing beneath the surface, and silver may be one of them. Here's what most people don't realize. Gold and silver often move together, but they don't move for the same reasons. Gold is primarily a monetary asset. Silver lives in two worlds. Part of its value comes from wealth preservation, but much of its importance comes from industry. That distinction matters. According to the Silver Institute and Metals Focus, the silver market has experienced multiple years of structural deficits, with demand exceeding supply and inventories gradually being drawn down. Recent surveys suggest these shortages have persisted far longer than many analysts expected. Yet mainstream coverage tends to focus almost entirely on gold. Why? Because gold sits inside central bank vaults. Silver sits inside the economy itself. Think of the global economy like a machine. Gold functions as insurance. Silver functions as wiring. And when economies electrify, digitize, and automate, that wiring becomes increasingly important. If you're interested in understanding the forces shaping precious metals and the global economy, consider subscribing. I post videos like this regularly. Now let's examine the supply side. Imagine trying to fill a swimming pool while someone keeps turning off the hose. That's the challenge facing the silver market. Unlike gold, most silver production comes as a byproduct from mining other metals like copper, zinc, and lead. That means silver supply isn't easily increased just because prices rise. Even if silver doubles, miners cannot instantly produce more. Many deposits are becoming deeper. Ore grades have been declining. Energy costs remain elevated. Permitting new mines often requires a decade or more, and geopolitical risks are becoming increasingly important. Mexico remains the world's largest silver producer. Peru is another major source. China, Russia, Chile, and Australia also play crucial roles, but each region faces its own challenges: political instability, environmental regulations, rising labor costs, infrastructure bottlenecks, and declining ore quality. Let me explain this with a simple analogy. Imagine trying to run a bakery where the ovens consume more energy every year, ingredients become harder to find, and opening a new location takes 15 years. That's essentially the mining business. Even after higher prices, production growth remains relatively modest, and because silver is often a byproduct, the amount produced depends heavily on demand for completely different metals. The result is a system that lacks flexibility, and inflexible systems tend to experience stress when demand suddenly rises, which brings us to the other side of the equation. Silver isn't just jewelry. It isn't simply a precious metal, it is an industrial necessity. Every solar panel requires silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure depends on it. Medical equipment uses it. Consumer electronics rely on it. And increasingly, artificial intelligence infrastructure is creating new demand. AI data centers require enormous electrical systems, semiconductors, and power distribution networks. Silver's conductivity makes it difficult to replace in many applications. According to industry reports, industrial demand has reached historically elevated levels over recent years. Solar demand alone transformed the market. Although manufacturers are attempting to reduce silver usage through engineering improvements, overall industrial consumption remains substantial. Think about it. The same metal used for wealth preservation is also consumed by technologies governments are actively promoting. That's a rare combination. Unlike gold, which largely remains above ground, much industrial silver gets dispersed into products and becomes uneconomical to recover, which means part of the supply effectively disappears. If this analysis is helping you connect the dots, subscribe and join our growing community here at Precious Metals Alert. History rarely repeats perfectly, but it often rhymes. During the inflationary 1970s, precious metals experienced extraordinary volatility. During the 2008 financial crisis, investors sought safety as confidence in financial institutions collapsed. During the pandemic, supply chains fractured and shortages emerged everywhere. Energy shocks repeatedly exposed vulnerabilities throughout the global economy, and in recent years, markets witnessed periods of extreme tightness and short squeezes. These episodes remind us that systems built for efficiency often become fragile under stress. Markets don't move in straight lines. They move in cycles. Confidence expands, confidence contracts, liquidity appears, liquidity disappears. And when uncertainty rises, investors tend to reassess risk. Silver's dual nature means it can respond to both industrial trends and monetary conditions. That's why periods of inflation, geopolitical instability, and supply disruptions deserve attention. Not because history repeats exactly, but because human behavior rarely changes. Fear, greed, complacency, optimism. These forces remain remarkably constant, and markets have always reflected them, which raises an important question. Why are sophisticated investors paying attention? The answer isn't necessarily about predicting tomorrow. It's about understanding probabilities. Governments around the world continue carrying enormous debt burdens. Deficits remain elevated. Currency debasement concerns have not disappeared. And nations increasingly seek alternatives to excessive dependence on the dollar system. Central banks have accumulated gold at historically strong rates. BRICS nations discuss trade diversification. Family offices emphasize hard assets. Institutional investors monitor commodity cycles. And concerns about resource security continue growing. Organizations like the IMF, World Bank, and U.S. Treasury repeatedly highlight rising debt and fiscal pressures. Smart money understands something simple. Fiat currencies come and go, debt cycles come and go. But scarce resources remain essential. That doesn't guarantee higher prices. Nothing is guaranteed. But strategic assets become increasingly valuable when confidence weakens. If you're finding value in these deeper macro insights, consider subscribing because we cover the stories mainstream media often overlooks. So what does all this mean for ordinary people? Ultimately, this conversation isn't really about silver. It's about purchasing power. It's about preserving savings. It's about understanding risks. And it's about preparing rather than reacting. No one can predict the future with certainty. No analyst, no central banker, no billionaire investor. But understanding the forces at work allows people to make better decisions. Diversification matters. Long-term thinking matters. Risk management matters. Patience matters. And education matters. Silver should never be viewed as a magic solution, nor should any asset. But history consistently rewards people who understand cycles and avoid emotional decisions. Because inflation affects retirees, debt affects savers, currency debasement affects workers, and financial uncertainty affects everyone. Wealth preservation isn't about becoming rich overnight. It's about protecting what you've already earned, and sometimes preparation matters more than prediction. As we step back and connect the dots, a fascinating picture emerges. Gold continues attracting headlines. Central banks continue buying. Debt continues expanding. But beneath the surface, silver sits at the intersection of two powerful forces: monetary uncertainty and industrial necessity. Supply remains constrained. Demand continues evolving. Geopolitical competition intensifies. And history reminds us that periods of stress often reveal vulnerabilities few people notice beforehand. None of this guarantees dramatic outcomes. Markets are unpredictable. Cycles unfold differently every time, but the underlying principles remain remarkably consistent. Scarcity matters. Supply and demand matter. Human psychology matters, and strategic resources matter. Markets move in cycles. Headlines come and go, but the laws of supply and demand never disappear. Pay attention to the trends most people ignore, because sometimes the biggest opportunities emerge long before the crowd notices. If you found this analysis valuable, please like the video, subscribe to Precious Metals Alert, and share it with someone who wants to understand the changing world around us. Another factor that deserves far more attention is energy, because every ounce of silver starts with energy. Mining is one of the most energy-intensive industries in the world. Diesel powers trucks. Electricity runs mills and processing plants. Explosives, transportation, refining, and logistics all depend on affordable and reliable energy. And here's the problem. The world is simultaneously trying to electrify while facing growing pressure on energy infrastructure. Oil markets remain vulnerable to geopolitical tensions. Natural gas supplies continue to influence industrial costs. Electric grids are under strain from AI data centers, electric vehicles, and expanding renewable energy systems. Think of the mining sector like a factory whose operating costs depend on the price of fuel. If energy becomes more expensive, producing metals becomes more expensive. That's exactly what many miners have experienced over the past several years. Higher wages, higher electricity costs, higher transportation expenses, higher environmental compliance costs. These pressures squeeze profit margins and discourage investment in new projects. And because major discoveries have become increasingly rare, replacing existing mines isn't easy. Many analysts focus exclusively on metal prices, but the reality is that energy and metals are inseparable. Civilization runs on energy, and energy determines the cost of extracting nearly every resource modern society depends on. Here's why this matters. If demand continues rising while production costs keep increasing, the margin for error becomes smaller. And history shows that commodity markets often appear balanced, until suddenly they aren't. The result can be years of stability followed by periods of rapid repricing. Not because markets become irrational, but because supply constraints eventually collide with reality. Perhaps the most overlooked aspect of silver is national security. For decades, globalization encouraged efficiency. Countries assumed supply chains would always function smoothly, but recent events have changed that assumption. Trade disputes, sanctions, wars, export restrictions, and growing geopolitical competition have forced governments to rethink strategic resources. Semiconductors have become strategic. Rare earth elements have become strategic. Copper has become strategic, and increasingly, silver belongs in that conversation, because modern defense systems depend heavily on advanced electronics, missile systems, satellites, radar technology, communications equipment, drones, artificial intelligence infrastructure, all require highly conductive materials. Silver plays a role in nearly every one of those systems. Think about it like this. Previous generations fought over oil. Future economic competition may increasingly revolve around technology, energy, and the metals that make both possible. China, the United States, Europe, and emerging BRICS economies are all competing to secure supply chains and reduce vulnerabilities. Governments understand something markets sometimes forget. National security isn't just about armies. It's about resources. It's about energy. It's about manufacturing. And it's about maintaining access to the materials that power modern civilization. specialization, which means silver's importance extends far beyond jewelry stores or investment portfolios. It sits quietly inside the technologies that define the 21st century, and when strategic resources become harder to replace, governments, corporations, and investors all begin paying closer attention. That's why many experienced resource investors believe the coming decade could be defined not only by financial cycles, but by competition for the physical materials that make the global economy possible.